Hi, everyone. Welcome to our session on PMS Decoded Wealth Building Strategies. Today, we have our InCred AMC team here with us. Mukesh is there along with us right now on the webinar, and Aditya is joining soon. We will start with a brief introduction about the InCred AMC, the team, and everything that the products and all that we are talking about. Uh, Mukesh, handing it over to you. Please continue with the presentation.
Thank you, Sahil, for this opportunity. On behalf of InCred, I welcome you all for this session. Uh, so, idea is to, take you through or make you understand how PMS actually makes difference in your portfolio. How, what are the strategies you can adopt in your portfolio? InCred as an AMC altogether runs three portfolio. We have multi-cap portfolio, we have small and mid-cap portfolio, and we have a dedicated healthcare PMS. Now, before we get into details about these strategies, I would like you to introduce you to InCred. What is InCred all about? Give me a second. So InCred as a group is started by Mr. A gentleman called Bhupinder Singh. He's ex-Deutsche, corporate finance, equity, and debt head for Asia Pacific region. Okay, way back in 2015, he came back to India and he started InCred Group. InCred, under the brand InCred, we have two verticals. We started with InCred Finance, which became Unicorn last year. Uh, we are into NBFC, typically your consumer loans and MSME loans. As we speak, we are around 12,000 crores of valuations under InCred Finance. We also have a second vertical called InCred Capital. This vertical basically has all fee-based business under its umbrella, namely your investment banking, equity, research and broking, asset management, which I am part of, and InCred Wealth Management. InCred Premier is again part of InCred Wealth. This is the journey so far. Like I said, way back in 2016, we started this business. Okay, we initiated InCred Capital in 2018 with wealth management. Later, we acquired advisory firm, investment banking firm called MAPE, and made an entry to in investment banking equity research over there. Later, in 2021, we started with InCred Asset Management. We started with InCred Money for investors, and then last 2023, we started InCred Credit Opportunities under CAT2 AIF. So that's the debt fund we run currently. InCred is backed by marquee investors like KKR, InvestCorp, Paragon Partners. These are all marquee investors who've invested in a lot of big names and have made multi-bagger returns in a lot of Indian startups in the past 20 years. Mr. Bhupinder Singh, like I said, I've already introduced him. He's the one who leads and is the torchbearer for InCred Group. The differentiating factor about InCred as a group is all the verticals are headed by gentlemen who have global exposure, have led India business in past 20-25 years. They have worked with a lot of MNCs where the product which possibly are not available in India till now, and they've worked with a lot of MNCs and introduced those products in India. Through our NBFC vertical InCred Finance, we have brought in a lot of synergy between different verticals like asset management, where so through NBFC we have got entry to a lot of corporates. We have lent them. We have been successful We have done a lot of successful transactions through investment banking. That experience has helped us in our credit fund, though a lot of experience with a lot of corporates in India has helped us in listed equity also. Apart from that, we have expanded beyond India's geography. At present we have presence in Singapore, Dubai, UK, and US. Uh, we do a lot of transactions internationally, and we are coming up really fast in those geography also. To concentrate on in InCred Asset Management, we have four different verticals, namely long only equities. Typically, these are basically your listed uh, companies investment. Second one is performing credit. This is under AIF CAT 2. Third one is absolute return product, which for us is typically your long short funds. Uh, you know, uh, these under category 3 AIF. Fourth one is private equity, again CAT 2 AIF, where we invest in unlisted equities, which typically are you know few years away from their IPO listing. We try to identify those company, do our own due diligence and invest, become an early investor for retail investors. So today we will focus on, because we are focusing on portfolio management service. This is part of long only equities. I had mentioned it before. We have three PMS managed by two gentlemen called Aditya Sood. Aditya Sood has experience of 20 years plus. He's prior to joining InCred, he was part of ICICI Prudential Asset Management. He's the one who grew PMS AUM for ICICI Prudential from 400 crores to 4,000 crores. Uh, the biggest achievement for him is a fund called Pipe, which was initiated by him. He is one of the guy who actually was able to deliver 36% CAGR return in a span of 4 years under Pipe Fund. Uh, that along with that, he was the only person I remember in asset management who returned money way back in 2018 January, before we saw market crash. Aditya Sood is also believe that returns on capital is important for investors, but returns of capital is equally important, and that is why he gives a lot of importance to valuations in all those companies. Uh, Mr. Aditya Khemka runs a unique fund called Healthcare Portfolio. He's the guy who leads, who understands pharmaceutical business, who understand a lot of sub-segment under healthcare, namely your diagnostic, hospitals, API manufacturing, India-centric branded medicine business, and something which is more of an export-oriented business, which is US generic medicine business. Aditya has been around for last 18 years plus now. He started his career with Glenmark Pharma, where he was part of their treasury. He used to do due diligence for Glenmark Pharma for the companies which they eventually used to buy out. He started his career with Latin America, later moved to US. Unfortunately, there he used to do equity research for US pharma companies. In Lehman Brothers, unfortunately, 2008 crisis, Lehman Brothers was taken over by Nomura. He was moved to UK, where he has done equity research for pharma companies based out of UK. And later he came back to India. Here he joined Ambit Capital, did equity research on Indian pharma segments. So by and large, Aditya has exposure to a lot of international region and has seen businesses in different geographies, and that is what is helping him curate a portfolio which is quite unique in the market today. When we look for exposure in pharma segment, we try to invest in a lot of pharma MFs, but there is a differentiating factor which I'm sure Aditya will take us through. Um, Aditya has joined us. Hi, Aditya.
Hi, Mukesh.
Hi. So I would like to welcome Aditya for this session. Aditya, I've taken everyone through what InCred is all about. Uh, a brief about our PMS products and other related products under asset management. With this, I would like you to take us through what is InCred Healthcare Fund altogether. Okay, how is it different from other pharma funds in the market? Over to you, Aditya.
Sure. Thanks, Mukesh. And hi, everyone. Good evening. First of all, thanks for your time. Has been a great value creator for our investors. Also, how it is very different from the mutual funds that are available in the healthcare space. So I'm assuming my background was already covered, so I'm not going to cover my background. I'll just start with why healthcare first. So generally, when we talk about the healthcare PMS, we get three questions from our clients. First question generally is why invest at all in a healthcare product? Why invest only in healthcare or a thematic product or a sectoral product like healthcare? The answer to that question is, if you look at this data, so BSE healthcare data is available since 2012. So my chart begins at 2012. So if anybody had invested 100 rupees in Nifty 50 in January of 2012, today they would have around 400 rupees. So that's about 12% compounded returns for Nifty 50 for the last 13 years, right? And the same 100 rupees, had you invested in purely BSE healthcare as an index, that 100 rupees would be today worth around 650 rupees. That's the orange line that you guys can see. So you would have outperformed Nifty 50 by 250 rupees had you just invested in BSE healthcare as an index, right? That's about 7% compounded alpha over Nifty 50 over 13 years, right? So that's a very significant alpha that one would have generated had they only invested in healthcare index versus Nifty 50. Now, if I further divide healthcare index into two halves, there is large cap healthcare companies and there is small and mid cap healthcare companies. The large cap healthcare companies, the dark blue line, this line, and the small and mid cap healthcare companies, that's the green line. So had anybody invested only 100 rupees in large cap healthcare companies, your 100 would have become 500. So you would have still done better than Nifty 50, but only marginally better, only 100 rupees of alpha over 13 years, which is like 3% compounded alpha. Or at the same time, had you invested 100 rupees only in small and mid-cap healthcare companies, that 100 would have become 1200 rupees. So that's 3 times the return of Nifty 50. That's an alpha of close to 18% over 13 years. So clearly, there is a case for investing purely in healthcare because over long cycles of time, you make, significantly higher returns than Nifty 50. And intuitively also it makes sense, right? Because Nifty 50 has a lot of cyclical sectors, exposure to cyclical sectors like banking, like auto, like cement, and so on and so forth. Whereas healthcare, intuitively is very, very secular in nature. However, within healthcare, if you see the outperformance of healthcare versus Nifty 50, and especially the small and mid-cap healthcare versus Nifty 50, it has been secular. It has been there for the past 13 years consistently. The extent of outperformance might vary from year to year, time frame to time frame, but it has been consistently outperforming. So that's the reason why, we encourage investors to take exposure in purely healthcare as a theme rather than investing in very diversified buckets where, you have a lot of cyclicality in the performance of the stocks. Now, that's the first question to answer as to why invest purely in healthcare. The second question that I need to answer here is, why do small and mid-cap healthcare companies generate better returns than large-cap healthcare companies? Now, large-cap healthcare companies are mostly unbranded generic companies. Now, what is an unbranded generic business? To give you an example of large-cap healthcare companies, examples would be Sun Pharma, Cipla, Lupin, Cadila, Biocon, Aurobindo, Dr. Reddy's, so on and so forth. Now, if you think about it, most of these companies, these large cap companies, their primary business model is to wait for a product to go off patent in US or Europe, and then reverse engineer the product and then sell it for a cheaper price in US and European markets. Now, in that business model, there is one problem. The problem is that there is no differentiation in the products of the competitors. So, for example, if there is a patient in US and he has fever, he goes to the pharmacy and he says, I want paracetamol 500 mg. Now, the doctor writes prescription paracetamol 500 mg, and the patient goes to the pharmacist and he asks for paracetamol 500 mg. Now, the pharmacist will tell the patient that he has paracetamol 500 mg of Sun, Cipla, Lupin, Biocon, Dr. Reddy, Cadila. Which one does the patient want? So the patient will invariably select the product which is least priced. Now, because there is no differentiation in the products of the competitors, the product in the US and the Western European market is sold on the basis of price. That is exactly the definition of a commodity, where there is no differentiation between different manufacturers and the product is sold purely on the basis of price. Now, in a commodity market, manufacturers make money when demand is more than supply. However, unfortunately, for the last 7-8 years, in the US generic market and the Western European market, the supply has been outstripping demand. Hence, if you see, let's say the 10-year stock returns of Sun Pharma is 50%, 50%, not CAGR, point-to-point return, which is 3% CAGR returns for a stockholder of Sun Pharma. Same for, let's say, a company like Lupin. The 10-year stock returns of Lupin is 0. It was 2,100 rupees 10 years back. It is 2,100 rupees today. 10-year returns in Cadila is like 12% or 11%, so on and so forth. So these companies which are more focused on non-branded generic essentially do not generate more than 15% CAGR returns for its shareholders, because they are in a business where the ROEs are really, really poor. And poor return on equity does not attract high multiples, and hence they don't generate shareholder wealth. So we do not invest in the unbranded generic bucket. So the second bucket where actually we invest is branded generic bucket. Now, these are companies like Torrent, Alchem, Mankind, Cipla, not Cipla, Torrent, Alchem, Mankind, Indoco, Ipca, Eris, Encure, etc. Now, these companies, if you see, their primary business model is to sell products in India. Now, in India, what happens if there's a patient, he has fever, he goes to the doctor, and the doctor writes a prescription saying Dolo. The patient goes to the pharmacy and says, give me Dolo. There is no discussion on price. Whatever is the price, the patient has to pay. It is 30 rupees, it is 50 rupees, it is 40 rupees, it doesn't matter. He will pay. So here in the branded generic markets, essentially the product is sold by the name of the product and not the price of the product. Hence, there is a differentiation in the products of the competitors and my product, because there is a brand. And hence, in this market, pharma companies actually behave more like FMCG companies, because they don't actually manufacture what they sell. They give it to third parties to manufacture. They brand the product and they promote the brand. The job here in the branded generic segment is to promote the brand. And hence, it is more of an FMCG business. If you realize Hindustan Unilever, P&G, Colgate, they do essentially the same thing. They basically don't manufacture the soap, oil or shampoo. They buy the soap, oil and shampoo, and they brand the soap, oil and shampoo, and then they promote the brand. So that is how this business is also done. The third bucket, which is the API CDMO bucket. Now, in the API CDMOs, what is API and CDMO? API is essentially the raw material for pharmaceuticals. Now, historically, the raw material for pharmaceuticals has been the forte of China, where China today supplies 80% of the drugs that are available in the pharma space. So basically, if you are US or you are UK, 80% of the drugs that are available in your country, the raw material comes from China. Now, the problem in this space is today that the world doesn't trust China anymore. Now, because the world doesn't trust China anymore, they want to develop an alternate vendor other than China, which is called China Plus One. And India is the only other country which can give them the cost, capacity, and capability that China offers. And hence, the API CDMO companies in India are sort of benefiting from this China Plus One trend. So we believe next 5 to 10 years for the API CDMO companies are going to be fantastic run. The fourth segment within healthcare where we invest is hospitals. Hospitals essentially are the only business in my understanding in the world where the seller tells the buyer what to buy, when to buy, how much to buy, at what price to buy. You know, there is no other business in the world where the seller exercises this kind of bargaining power against the buyer. Now, hospitals historically have not been great value creators because mostly older hospitals, the owner of the hospital used to own the land and building on which the hospital stood, which made the business very capex intensive and which also made expansion really, really slow because every time you wanted to open a new hospital, the amount of capex required was very, very large. But what has happened in the last 7 to 8 years is that hospitals have started expanding using the asset-light strategy. Under the asset-light strategy, they essentially don't buy the land and building, they lease the land and building, and then they open the hospital. So this has resulted in better margins, better ROEs, and faster expansion. So hospitals are now started creating a lot of shareholder wealth, and the valuations remain very, very comfortable. So we are highly invested in hospitals as a sector where we feel a lot of money is going to be made in the next 2 years, 3 years. Diagnostics, very, very similar story, that 85% of the diagnostic market in India tends to be unorganized, and 15% of the market is organized. Now, obviously, the organized players are growing faster than unorganized, and the market itself is growing at 10%. So the organized guys are growing between 12 to 15%. Hence, if you are growing 12 to 15% top line, bottom line growth tends to be 18 to 20%, which is a great growth company, to invest in over a long period of time. So these are the 5 buckets of healthcare. Now, how are we different from the different mutual funds that also offer healthcare funds? If you see, these are the 5 categories we discussed. This is the weight of the mutual funds in those categories. This is the weight of the index in those categories. This is our weight in those categories. Now, if you see, mutual funds have only 15% in hospitals because the index has 16% in hospitals. We have 32%. So we are far more bullish on hospitals than the mutual funds. Diagnostics, 3% for mutual funds, 2% for the index. We are at 25%. So we are again very, very bullish on diagnostics. Generics, 41% of mutual funds, 43% of the index, 0% for us. We do not invest in businesses which will give us 3 or 5% compounded returns over 10 years. We don't like that. APIs or CDMO, 15% for mutual funds, 16% for index, 14% for us, 20% branded generics for us and the mutual funds, 22% for the index. So that's, and the others that you see is largely cash. So you can see that the make of our portfolio is very, very different from the index and the mutual funds, whereas the make of the mutual fund portfolio is very, very similar to the index, which is where we completely differ from the mutual fund basket. Last but not the least is now a good time to invest in the healthcare product. So what we do is we basically look at the earning growth at a portfolio level. So if you notice what we are seeing in FY25 so far, in the first half of FY25, the top line growth of our fund companies is around 13%, and the bottom line growth is 40%, 40. Remember, guys, 40% PAT growth YOY in the first half of FY25 should be compared to 7% PAT growth that Nifty 50 has reported in the first half of FY25. This is the reason why our fund has delivered far superior returns than the benchmark, because the benchmark earning is growing between 7 to 10%, and our fund earnings are growing at 40%. So obviously these stocks are doing phenomenally better than the stocks that we do not own, right? Going into FY26 and 27, the next 2 years, the outlook is that earnings should grow at 33% and 28% for the next 2 years. So if I add the two growth rates, right, 33 and 28% earning growth, if I add the two, it comes to this is the growth rate, 33% in FY28, PAT growth, 26, PAT growth 33%, and 28% PAT growth in FY27. So if I add the two, I'm looking at 60% earning growth in the portfolio companies in the next 2 years, which implies that even if the multiples fall by 10-15% because the market is in a correction mode, investors can still expect anywhere between 40 to 50% returns over a 2-year period from the product, which we think in the current market is phenomenal returns to be yielded in the next 2 years. So which is why we feel currently also the timing is absolutely good to invest in the product. In terms of performance, we have compounded capital at 23% since inception. The product is almost 4 years old now. We have alpha of 5% against the broader benchmark index and 1.5-2% against the healthcare index over the last 4 years. This is post fees and charges. Obviously, the benchmarks don't have fees or charges. So that's how the performance stands. It is a 14 stock portfolio, and top 10 stocks, the weightage, the concentration is pretty high. So it's a high conviction calls portfolio, and it is not like we are giving you a portfolio of 60 stocks, 70 stocks, 80 stocks. That's not what we are for. That's not what we stand for. So this is fairly concentrated portfolio, high conviction bets, and the churn in the portfolio tends to be between 20 to 25%. So our average holding period tends to be 4 to 5 years for any given equity stock. So I'll pause here.